contractor walks the damage and writes an estimate. $40,000 to put the house back. 3 weeks later, a check arrives for $18,000. The claim was not denied. Nobody accused anyone of anything. The policy limit is far above $40,000. And the gap has 4 separate causes, none of which is a dispute about whether the damage happened: a deductible, a valuation method, a scope disagreement measured in line items, and a portion of the money that exists is owed and has not been released yet. Almost everything people describe as being cheated by an insurance company happens in that gap, and most of it is procedural, written down, and knowable in advance. Hey, welcome back to Policy Unpacked. If you're new here, this is where we read the fine print so you don't have to, in plain English with no sales pitch. Glad you're here. Today, what actually happens after you pick up the phone? Every step in order. Quick ground rules first. And notice when people learn about it. Not when they buy the policy, not at renewal. They learn about it in the worst week of their year, standing in a damaged house, holding a check that does not match the estimate, trying to understand a process they have never seen before while a contractor waits for an answer. That is the wrong moment to learn anything, so we are going to walk the whole sequence now. In order, while nothing is on fire. Quick ground rules. This is general education about how a U.S. homeowner's claim typically proceeds. Not advice about your specific claim and not legal advice. Timelines, requirements, and consumer protections vary by state and by insurer. Everyone and every dollar in this episode is a simplified, illustrative example. If you are in a live claim, your policy and your state's insurance department are the authorities, not this video. Step 1. You report the loss. In policy language, this is notice of loss, and it starts the clock on everything else. 2 obligations arrive with it, and both are in your policy under the Duties After Loss section. The first is prompt notice. Policies require you to report within a reasonable time, and a long, unexplained delay can genuinely become a coverage problem, particularly if it makes the damage harder to assess. The second is protecting the property from further damage. If a window is broken, you are expected to board it. If a pipe burst, you are expected to stop the water. That second duty is more useful than it sounds, because the reasonable cost of those emergency measures is generally covered, but only if you keep the receipts. And here is the practical piece that matters more than any other in this episode. Before anything is cleaned up, photograph everything. Wide shots of each room, close shots of each damaged item, the serial numbers on appliances, the water line on the wall. Photographs taken before mitigation are the only evidence that exists of what the damage looked like at its worst. Think of it this way. From the moment you clean up, you are asking someone to price a thing they cannot see. The photographs are the thing they can see. Step 2. An adjuster is assigned, and this is the part where a plain answer helps most. A staff adjuster is an employee of your insurance company. An independent adjuster is a contractor hired by your insurance company. Both are paid by the insurer. That is not an accusation. It is a job description, and it is worth saying out loud because people are often unsure whether the adjuster is neutral. The adjuster's job is to determine what happened, what the policy covers, and what it costs to repair. They are bound by the policy language and by their state's claim handling regulations. And in most states, those regulations carry real obligations about timeliness and communication. There is a third kind, and the difference matters. A public adjuster works for you and is typically paid a percentage of your settlement. They are licensed and regulated. They can be genuinely valuable on large or complex losses, and that percentage comes out of your money. The episode makes no recommendation about hiring one. It exists, it is regulated, and you should know the category is there. There is a fourth party who appears in larger claims and confuses people badly, so let us name them too. On a complex or high-value loss, an insurer may engage a specialist, a structural engineer, a fire investigator, a forensic accountant. their report can carry substantial weight in the outcome. They are genuine experts, and they are being paid by one side. Both of those things are true at once, and neither is improper. And that matters for one practical reason. If a claim is declined or reduced on the basis of an expert report, you can ask for that report, and it is a document with reasoning in it that a different expert can examine. A denial resting on an engineer's conclusion is a very different thing from a denial resting on a policy exclusion. The first is a finding, and findings can be contested. The second is the contract. Now, what actually happens at the inspection? The adjuster documents the damage, measures the affected areas, photographs it themselves, and builds a scope of loss. A list of what has to be done to repair it. Not a price yet, a list. And that list is where most claim disputes are actually born, long before anyone argues about money. If the scope says repaint one wall and the correct repair is repaint the room because the paint cannot be matched, the disagreement is about a line item, not about honesty. Matching is worth pausing on because it produces more genuine disagreement than almost anything else in a claim. Suppose hail damages one side of your siding and that siding has not been manufactured for 8 years. Repairing the damaged side is straightforward. Now, your house has two visibly different sides. The same question arises with flooring that runs continuously between rooms and with roof tiles no longer in production. This is not an insurer being difficult. It is a genuinely hard boundary. How far does restore what was damaged extend when the undamaged part no longer matches? So the scope becomes an estimate. Where does the price come from? Step 3. The scope gets priced, and here is a fact that explains a great deal of confusion. Most insurance estimates are built in specialized estimating software using regional pricing databases. Costs for materials and labor updated periodically for your area. The one you are most likely to encounter is called Xactimate, and many contractors write in it too, which is why the two documents often look similar in structure even when the totals differ. So an insurer's estimate is not usually a number someone invented. It is a line item build. So many square feet of drywall, so many hours of labor, at database prices. Your contractor's estimate is also a line item build, using their own costs, their own margin, and their own read of the scope. Two documents, same house, different totals. And now, the useful reframe of this whole episode. When those numbers differ, the productive question is almost never, why is the insurance company lowballing me? It is, which line items differ and why? Because a $40,000 versus $28,000 disagreement is not one gap. It is usually a dozen small ones. Different quantity of flooring, different grade of material. One estimate includes the cost of moving furniture out. The other does not. One prices matching cabinets. The other prices refinishing them. Ask for the insurer's estimate as a line item document. Most will provide it and put it beside your contractor's. The differences become visible immediately, and a specific question about line 14 gets a very different response from a general complaint about the total. Here is the analogy. If two builders quote different prices for the same kitchen, nobody assumes fraud. They assume different specifications, and then they compare the specifications. A claim estimate deserves the same treatment and almost never gets it. Step 4. Coverage determination. Is this loss covered and under which part of the policy? This is where everything from episode 5 comes back. Was the cause a covered peril? Is this the structure or the contents, and are they on open peril or named peril? Does an exclusion apply? A partial determination is common and confuses people badly. An insurer can cover the water damage to your floor and decline the cost of repairing the failed pipe that caused it. Because many policies cover resulting damage while excluding the failed component itself. That is not the insurer being inconsistent. It is one of the most common lines in the form. But nobody experiences it as coherent when it happens to their kitchen. Step 5, the deductible, and it is simply subtracted. On our illustrative $40,000 loss, a $2,000 deductible means the insurer's exposure begins at $38,000. And remember the trap from episode 5. If the cause was wind or hail, you may have a separate percentage deductible instead. 2% of a $400,000 dwelling limit is $8,000. 4 times the flat deductible on the same house for a different cause of loss. One more piece people miss. The deductible applies per claim, not per year. 2 separate losses in 1 year usually means paying it twice, which leads to a calculation worth doing before you file anything at all. If your deductible is $2,000 and the damage is $2,600, the claim is worth $600 to you. And filing it puts a claim on your record, which insurers consider at renewal and which in some states can affect your pricing for years. So a small claim can genuinely cost more than it pays. Not always, but often enough that, should I file this at all, is a real question, not a trick. The rough guide most people find useful. If the loss is close to your deductible, think hard. If it is several multiples of it, file. And if you are unsure whether an event is even reportable, you can usually ask an insurer a general question about coverage without opening a claim. But confirm that before you call, because practice varies. Step 6. Payment is issued. And on a replacement cost policy, the first payment is usually not the whole settlement. Recall the mechanism from episode 5. Replacement cost value is what it costs to replace today. Actual cash value is that minus depreciation. Many policies pay actual cash value first and release the depreciation after the work is done and documented. So the first check is the depreciated amount minus your deductible. The remaining money, recoverable depreciation, is genuinely owed to you and is genuinely withheld until you prove the repair happened. And that mechanism has a real consequence worth stating plainly. It requires you to fund the gap in the middle or find a contractor willing to work on the first payment and wait for the second. For a household without savings, a fully covered claim can still be difficult to complete. That is not a loophole. It is the structure, and it is invisible until you are inside it. Step 7, and this one blindsides almost every first-time claimant. If you have a mortgage, your lender's name may appear on the check alongside yours. The reason is straightforward once said. The lender has a financial interest in the house securing their loan. If the house is damaged and the repair money disappears, their collateral is worth less. So on larger claims, the payment is often made jointly, and the lender releases funds in stages as the work is inspected and completed. Small claims are frequently released in full straight away. Thresholds vary by lender. This is normal. It is also a step nobody mentions until you are holding a check you cannot deposit alone, and it can add weeks that have nothing to do with your insurer. And it produces a genuine bind that catches people out. The lender wants to see work completed before releasing funds. The contractor wants payment, or at least a deposit, before starting work. Each position is reasonable. Together, they can stall a claim entirely, and neither party has done anything wrong. The usual resolution is staged draws. The lender releases a portion up front, then more at inspection milestones. But you have to ask for that schedule, understand it, and give it to your contractor before the work is agreed. Which is why the single most useful call in this whole process is one almost nobody makes. Phoning your mortgage servicer early, before the check exists, and asking exactly what their lost draft process requires. So let us close the gap we opened with. $40,000 estimated, $18,000 on the first check. $2,000 of it is the deductible. A scope disagreement accounts for several thousand. Line items in dispute, not a denial. Depreciation on the aged components accounts for a large portion, recoverable once the work is done. And the balance is sitting with the mortgage company awaiting an inspection. 4 causes. None of them is a refusal to pay, and a homeowner who does not know these 4 steps exist will experience all of them as a single act of bad faith. Which brings us to what genuinely goes wrong, because sometimes it does. Every state has claim handling regulations that require insurers to act within defined timeframes and to explain a denial in writing. If those obligations are not met, the complaint route is your state's Department of Insurance, and it is free. The obligations run in both directions, and one of yours has a deadline attached. Many policies require a sworn proof of loss, a formal statement of what was damaged and what you are claiming within a set period after the insurer requests it. It sounds like paperwork. It is a condition of the contract. If an insurer requests one and the deadline passes, that can become a reason to deny a claim that would otherwise have been paid. So if a form arrives with the words proof of loss on it, that is the one you do not leave on the kitchen table. Most policies also contain an appraisal clause, a contractual process for resolving disputes about the amount of a covered loss where each side appoints an appraiser and they select an umpire. It resolves value, not coverage, and it costs money. And it is worth knowing that the majority of claim disputes are about amount, not about whether a loss is covered at all, which means the appraisal clause is relevant far more often than people realize. There is also a category of genuine misconduct, and it should be named plainly rather than hinted at. Unreasonable delay, failure to communicate, refusing to explain a denial in writing, requesting the same document repeatedly, denying without a reasonable investigation. Those behaviors have a name in most states: unfair claims settlement practices, and they are regulated precisely because they occur. Nothing in this episode is arguing that insurers are always reasonable. The argument is narrower and, I think, more useful. Most of what feels unfair is structural, and knowing the structure lets you spend your energy on the part that is not. A homeowner who understands depreciation, deductibles, and lender endorsements can tell the difference between a claim that is progressing slowly and a claim that is being handled badly. A homeowner who does not understand them experiences both the same way and often gives up on the second one. This episode takes no position on whether to use any of these. It says only that they exist, they are in your policy or your state's law, and knowing their names changes the conversation. 6 things to do in order if you are ever in a claim. 1. Photograph everything before you clean up and keep every receipt for emergency repairs. 2. Report promptly and write down the claim number, the adjuster's name, and the date of every call. 3. Ask for the insurer's estimate as a line item document and put it beside your contractor's. 4. When totals differ, ask about specific lines. Line 14, prices refinishing. My contractor prices replacement. Why? That question has an answer. Your offer is too low, does not. 5. Ask directly whether the settlement is actual cash value or replacement cost, and if replacement cost, what proof releases the depreciation, and by when. 6. Ask whether your mortgage company must endorse the check and what their release process requires. Ask this early, not when the check arrives. None of those 6 require expertise. They require knowing that the steps exist. The verdict on the claim process is not that it is rigged. It is that it is a sequence being experienced as a verdict. You expect one decision, yes or no, and a number. What actually runs is 8 steps, several of which subtract, one of which delays money you are owed, and one of which involves a third party you never chose. And the single most useful correction is this: the estimate is not the settlement, and the first check is not the settlement either. The settlement is what you have received when the file closes, which is often more than the first payment and almost never arrives all at once. None of this tells you how to handle your own claim. It cannot, and it should not. Your policy, your state's regulations, and the facts of your loss control your result. But every episode this season has ended at the same wall. Auto liability stops at a limit. Home liability stops at a limit. And when a loss is larger than the number on the page, the policy has nothing left to say. Next time on Policy Unpacked, umbrella insurance, the coverage that begins where your other policies stop, what it actually costs, and the situations where it does not apply at all. It is the least understood product in personal insurance and the one most often described as either essential or a waste of money. Usually by people selling something, we will do what we always do. Read the structure, run a scenario, and find the boundary. Because by now, the pattern of this season should be visible. Every policy is a promise with an edge on it, and the useful question was never whether you are covered. It is where the coverage stops and what is standing on the other side of that line. This is Policy Unpacked, how insurance actually works. No sales pitch.